Let's look at the Qs first. I mean, what a mess, right? So this is the correction. Boom, boom. This is called a bounce. There's a reason why I have a distinction between it, because bounces are something that if your indicators and price action and macro data lead you to believe there's more downside to come and the bounces can be bought, then you buy the bounces and double down for that, if it's a bounce. However, if it's a recovery, like that's a bounce, that you want to see it take that out, then you're basically in recovery, not full recovery. You really won't be in a full recovery until you take out that. That's when trend takes over. However, the short-term recovery, no longer bounce, is this trade where you trade long, and it has to be short-term. Hence the Microsoft trade. The Microsoft trade was in response to the software drop, which we'll talk about in a few minutes. Short-term. So if you get a bounce, you want to look to do a couple of things. You want to take advantage, perhaps, of the hedge that you put on. If you were shorting this and you put a hedge on just in case there's a bounce, when you get the bounce, take the profits. If the bounce fails and is not turning into a full-blown rebound, you can take the money from the hedge, and because the trade that you put down here, short, is now something that you might be able to get cheaper. So you take the money from the hedge and you do what? Average down, and then boom, boom, and you're in great shape. If the bounce is not just a bounce, it's more than a bounce, then typically your longer term short is going to suffer as price moves higher. So you're not going to bail on it just yet because you want to get an elegant entry to get out of it. But the bounce money that you got on the hedge, you can now take that money and short term, you then take this money and then you short term long it, like Microsoft. For a boom, 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 a day or two or three that week, you take that hedge money. It wasn't just a bounce. I'm just giving you an example here. It wasn't just a bounce. It was a little bit more of a bounce. You got some data, markets rallied, you broke through resistance, whatever it is. All right, so the short-term long that you take here, meaning call trade, you can finance that with the hedge money. But then what do you do with the longer term shorts? You wait for a pullback off of that short term long to make a decision. Do I ease out of my longer term shorts here and then I go flat? Or do I now double down, as it turns out it really was a bounce and not full recovery, and I stay in the longer term short, and I take the money that I made on the bounce and I average down on the longer term short, and I stay in it for this. If not, then I will take advantage of this as a pullback, ease out of that longer term short, and then start the process all over again of seeing, do I want to be bullish? Am I bearish? What am I doing? All right, I'll start with weekly longs. And if it continues doing this, I'll go out a month. And now I've got long-term longs. And what do I do just to protect? I hedge with a short. And now I'm working in the opposite direction. Does everybody get that?
Thanks for watching. Hope you enjoyed this video from Trade With Me Now. Make sure to go ahead and like this video and subscribe to our channel so you make sure that you catch our next video right when it's released. Also, if you have a question or comment, please leave that in the comments section below. And of course, if you want to learn more about Trade With Me Now or join our community of profitable traders, go to tradewithmenow.com. There's also a link in the description below.